Hello guys, so this is the part 2 of our TDS discussion. In the last session, we have already covered several sections. We've learned about section 194I, 194J, 194C. We've also discussed about 194LA, 194IA, 194M, 194N, multiple sections. We have some more sections left. Let's take them up one by one. The very first section I'm going to be discussing with you now is section 194IB. Section 194IB. Now, Section 194IB talks about TDS with respect to rent. Now, yes, with respect to rent, we have already learned a section. We have already learned Section 194I. But if Section 194I does not apply, then we check 194IB. So first we give preference to Section 194I. Only 194I is not applicable. Only then we come to Section 194IB. Just like all the other sections, let's draw a diagram for Section 194IB as well. Let's say there are two people in the story. We have the tenant and we have the landlord. Okay. Now the landlord has given to the tenant some land or some building on rent. If you remember, in Section 194I, we had land, building, plant, machinery, furniture, fixtures. Three options we had. But here I am not talking about furniture and fixtures. I am not talking about plant and machinery. I am talking only about land and building. So the first difference between Section 194I and 194IB is that 194I targets land, building, furniture, fixtures and plant machinery, whereas 194IB targets only land and building. So the landlord has given to the tenant some land or building on rent, and for this the tenant is going to pay rent to the landlord. Okay guys, now this rent, if Section 194I is not applicable to this rent, only then I think about 194IB. Now, why is 194I not applicable? There could be various reasons why 194I is not applicable. But please know, I'm not covering all the 100 reasons. There are only two reasons which I'm covering. 194I is not applicable either because it was personal rent. You know, right? Section 194 194C, H, I, J, these four sections, the transaction should not be for personal purpose. 194C, H, I, J, the transaction should not be for personal purpose. So 194I, it will not apply if you are paying rent for personal purposes. So if it is personal rent, 194I will not apply. Welcome to 194IB. This is the first reason. Or the second reason, if you see, 194I is an R hijack section. Now, because it is an R hijack section, you will be bothered about the preceding previous year turnover, preceding previous year gross receipt. So the second reason is that the preceding previous year turnover is probably within 1 crore, or the preceding previous year gross receipt. Preceding previous year turnover is within 1 crore, or the preceding previous year gross receipt is within 50 lakhs, whichever is applicable. Please notice, this is the first reason and this is the second reason, and in between both of these reasons I am putting the word or, which indicates it is not necessary that both the reasons have to be fulfilled. Either it is personal rent, and that is why 194I is not applicable, or the turnover gross receipts number are within 1 lakh, within 50 lakhs, and that is why 194I is not applicable. Only then I think about 194IB. Crystal clear, everybody till here? Yes. So point number one, 194IB will apply with respect to rent only relating to land and building, not relating to furniture, fixtures, not relating to plant and machinery. Point number two, it applies to rent only if 194I is not applicable. So I will always think about 194I first. Only 194I is not applicable because of any one out of these two reasons. Only then I think about 194IB. What are the two reasons? Number one, either it is personal rent, that is why 194I is not applicable, or the rent or the preceding previous year turnover gross receipt number is within 1 crore, within 50 lakh, as a case may be. So only for these two reasons, if 194I is not applicable, we will think of 194IB. Now see, there can be so many other reasons also where 194I is not applicable. If you remember, 194I applies only if the aggregate rent is more than 2,40,000. So if it is within 2,40,000, 194I will not apply. So in that case, can you come to 194IB? No, you're understanding. Only because of these two reasons you can come to 194IB and not because of any other reason. Now listen, there's one more catch under 194IB. In 194IB, see, who is earning the rental income? This rental income is earned by the landlord. For the landlord, this is income. For the landlord, the source of this income is a tenant. So at the source, we deduct the tax. So the tenant becomes the deductor and the landlord becomes the deductee, right? The special point under 194IB is that this deductor has to be only individual or HUF. If this deductor happens to be any other person, then 194IB will not apply. And if you see, there's actually logic behind this point, because see, personal rent, only individual HUF can have personal rent. Company can't have personal rent anyways. And also, if you see, this turnover gross receipt criteria is only for individual HUF, not for others. So are you noticing there is actually logic why 194IB is applicable only to individual HUF deductor? And the deductor is any other person, 194IB will not apply. Okay, so coming to the next point now, under 194IB, what is the limit? See, 194IB will apply only if the monthly rent is more than 50,000. Please note, I'm not talking about aggregate rent. If you look at 194I, we say aggregate rent has to be more than 2,40,000. But in 194IB, I am not talking about aggregate rent. I am talking about monthly rent. Monthly rent has to be more than 50,000. Only then 194IB will apply. Under 194IB, the tenant will deduct tax at the time of payment or credit, whichever is earlier, but only in the last month. Only in the last month. So this is a point which you will understand when I give you some examples. So the tenant will be deducting tax at the time of payment or credit, whichever is earlier, with respect to the last month. All right. And one more point, please remember that the monthly rent has to be more than 50,000. We're not talking about aggregate rent. We're talking only about monthly rent. Now see, I'll give you some examples to help you understand this a little better. Totally around 4 examples we will see. Listen to the first example. Let us say the tenant took on rent a particular house for him to live in. So it's personal rent, guys. 60,000 rupees per month he's going to pay as rent, and all 12 months he has lived in this house. So for all 12 months he's going to pay rent for this house. Okay. Now what did we learn? That tax will be deducted at the time of payment or credit, whichever is earlier, with respect to the last month. So in this example of mine, what will the last month be? The last month is going to be the month of March, right? So in the month of March, how much rent are we supposed to give to the landlord? We're supposed to give 60,000 rent to the landlord. Now, if you're noticing, this 60,000 is more than 50,000. The tenant is individual or HUF, let's say. It is personal rent. All my conditions are getting fulfilled. So therefore, yes, I can apply 194IB. So under 194IB, I will deduct tax. I will deduct tax in the last month. In the month of March, I will deduct tax. But in the month of March, when I'm deducting, I will not deduct just for March. I will deduct for the entire year in the month of March. You're understanding? We will deduct tax in the last month, but we will not deduct tax only for the last month. We will deduct tax for the entire year in the last month. So when will we deduct tax? In the last month. But for which transaction will we deduct tax? For the entire year, we will deduct tax in the last month. So in the entire year, how much rent have we paid? 60,000 into 12. Okay, and what's the TDS rate under 194IB? I did not tell you that the TDS rate under 194IB is 5%. Guys, remember we had learnt about section 194M in the last session. We learnt if 194C, H, J are not applicable, then we think of 194M. And now I'm saying if 194I is not applicable, we will think about 194IB. In both of them, what is a common point? In both, if you see, the common point is a TDS rate. In both, the TDS rate is 5%. In 194M also, in 194IB also, in both, the TDS rate is 5%. Both are sort of similar sections, no? Because if these 3 sections are not applicable, then you apply 194M. If this section is not applicable, then you apply 194IB. So are you noticing there is some similarity between these 2 sections? And there's one more similarity, and that is the TDS rate. In both, I will deduct the tax at the rate of 5% only. So 60,000 into 12 is a full year's rent. This into 5% is going to be how much? 36,000. So 36,000 tax will be deducted at source when not throughout the year. We will deduct tax only in the last month. So in the month of March, we will deduct 36,000. So what's the net amount left with? 24,000. This is the amount of money which the tenant is going to give the landlord in the last month. Understanding? So now you understood this part. So we will not deduct tax throughout the year. We will deduct tax for the year only in the last month of tenancy. Only in the last month, in the month of March only we will deduct. But in the month of March when we are deducting, we will deduct for the entire year. Okay. Now see, the same situation, we can complicate it a little bit by adding an extra adjustment. Let us say the tenant had vacated the property in the month of December. Then what will you do? Like same thing, guys, same situation only. The rent for the house is 60,000 per month. Because it is rent for the house, it becomes personal rent. Because it is personal rent, 194I will not apply. Rent per month is 60,000, which is more than 50,000. The tenant is individual or HUF. Asset is land or building. All my conditions are fulfilled. Only thing is that this property was vacated by the tenant on December 31st. Now tell me, what will the last month be? Will the last month still be March? No. If the tenant vacates a property in between the year, then the last month will be the last month in which he is vacating the property. Understanding? If he is occupying the property for the entire year, last month will be March. But if he is vacating the property in between the year, then the last month will be the month in which he is vacating the property. That is, in our example, December. So same calculation, guys. For December month, what is the rent? For December month, the rent is 60,000. Against this, we will deduct TDS, guys. So 60,000 into what? 60,000 you will not do into 12. Because here the tenant has occupied the property only till December. So therefore, we anyways have only 9 months. So 60,000 into 9 into 5%. This will be the tax deducted. So for the entire 9 months period, by deducting tax only in the last month, only in the month of December, this is going to be around 27,000. So in the month of December, we will actually end up paying the tenant only 33,000 of rent. Understanding? So now you know the significance of this last month concept. If the tenant has occupied the property for the entire year, we will do the deduction in the month of December. But if the tenant has if the tenant has occupied the property for the entire year, we will do the deduction in the month of March. But if the tenant vacates the property in between the year, then in the last month of tenancy, that is in the last month in which he is vacating the property, in that month we will deduct the tax. Alright guys, now listen, taking you forward to the next point, under 194IB only, I have to give you 2 more examples. See, you know about section 206AA? 206AA says that the deductee has to furnish either his PAN number or his Aadhaar number. At least one he has to furnish, PAN or Aadhaar, at least one he has to furnish. But if the deductee is neither furnishing his PAN number nor is he furnishing his Aadhaar number, neither PAN number nor Aadhaar number he is furnishing, then the TDS rate itself will change, guys. The TDS rate will now become 20% or whatever is the applicable rate in that particular section, whichever is higher. This is section 206AA. So 206AA says if the deductee is neither furnishing his PAN nor furnishing his Aadhaar, then the TDS rate will change. The TDS rate will now become 20% or whatever is the applicable rate, whichever is higher. Now, if you look at this section 194IB, in 194IB, who is a deductee? The landlord. If the landlord is neither furnishing his PAN nor furnishing his Aadhaar, you will apply 206AA. So 206AA will say 20% or the TDS rate, which is 5% in 194IB, whichever is higher. Clearly, which is higher? 20% is the higher rate. So now, if we combine section 194IB and 206AA, if we combine these two sections, let's say the landlord has neither furnished his PAN nor has he given his Aadhaar. So applying 206AA, the TDS rate will become 20% or 5%, whichever is higher, which obviously 20% is higher. So now in such case, how will the whole story change? So let's say the same thing, the last month. What is the last month again? In the first example, one second. In the first example, the last month is March. So in the month of March, 60,000 is a rent. From this, we will deduct TDS, right? TDS is going to be 60,000 for the entire year into what? Not 5%. If we apply 194IB plus 206AA, if we combine these two sections, the TDS rate will become 20%, guys. So now if you do the calculation, how much does the tax work out to? See, 60,000 into 12 into 20%, this works out to 1,44,000 rupees. So the net number is going to be negative, guys. 60,000 is March month's rent. From that 1,44,000 TDS, is it even possible to deduct? No. The TDS should not be more than the last month's rent. If the TDS is more than the last month's rent, then we will restrict it to the last month's rent. So even though it was 1,44,000, because 1,44,000 is more than 60,000, we will restrict it to the last month's rent. So in the last month, we will not pay any amount to the landlord. 60,000, full 60,000 will be deducted as tax at source. You're understanding? So the last month, so your conclusion, your learning from this point is that the last month's, the TDS should not exceed the last month's rent. If the TDS is exceeding the last month's rent, you will restrict it to the last month's rent. Alright. Now similarly, in this example also, let's apply 206AA. So the last month was December. For December, the rent was 60,000. From this, we will deduct tax at source. So 60,000 rupees into 9 months into not 5%. This time the rate will change to 20%. So how much is the TDS now? 60,000 into 9 months into 20%. This is going to be 1,08,000. Now again the same problem, guys. The TDS is more than last month's rent. TDS should not be more than last month's rent. So again, what will you do? You will restrict this to the last month's rent. You will restrict this to 60,000. So in the last month, we will actually end up paying nothing to the landlord, and the whole 60,000 will be deducted as tax at source. Understanding, everybody? So 194 IB, the whole of 194 IB, I've tried squeezing in into this one page. Let us quickly revise, guys. Under 194 IB, we deduct tax with respect to rent. That rent which is not covered by section 194I. Why? Either because it is personal rent or because turnover gross receipt numbers are within the limits. Under 194 IB, the deductor has to be only individual or HUF, only land or building, no furniture, fixtures, no plant and machinery. We deduct tax at the time of payment or credit, whichever is earlier, and we deduct tax not every month, we deduct tax only in the last month at the rate of 5%. Right, guys? The monthly rent has to be more than 50,000. Right? And then we learned that one more, the last conclusion that we learned was the TDS under 194 IB should not be more than the last month's rent. If the TDS is more than the last month's rent, then we will restrict it to the last month's rent. Okay, this is it about section 194 IB. Now listen to the next point, the next discussion. Under 194 IB, there is actually one more point, but you guys are already aware of it, so we don't have to spend too much time. Do you remember we had learned that under section 194 IA, under section 194 IB, and in section 194M, in these three sections, there is a common point. Right? You remember? We will see what is the end of the month of deduction. When was the tax deducted? What is the end of the month of deduction? From this date, within 30 days itself, we will have to file the challan cum statement. Remember, the payment of TDS to the government and the filing of TDS return is combined. These two steps are combined into one single step, which is challan cum statement under these three sections. So under these three sections, even 194 IB is one of the sections. So from the end of the month of deduction, within 30 days, the deductor will have to remit the tax to the government also and will have to file the statement also. So challan cum statement. From the expiry of these 30 days, within the next 15 days, the deductor will have to give the TDS certificate to the deductee. Right, guys? Generally, the TDS certificate and all is given quarterly, but however, in these three sections, it's slightly different. The challan cum statement has to be done within 30 days from the end of the month of deduction, and the TDS certificate has to be given within the next 15 days. This you are already well aware of. We have already seen this under 194 IA and 194M as well. Right, guys? So can we close this discussion of 194 IB? This was the first section, but a very important section of this session. Now let me take you to the next section. Next, we are talking about section 192A, a very simple section, section 192A, which talks about RPF withdrawal. Section 192A, RPF withdrawal. Listen to me. Under section 192A, there are two people in our story. Let's draw a diagram. We have the RPF on one side and we have the employee on the other side. Now, every month, employee and the employer both have contributed to RPF. Both have made savings in RPF. But tell me, employee and employer both are contributing to RPF and saving money for whom? For whose benefit? For the employee's benefit or for the employer's benefit? Of course, we know very well that we are saving money for the employee's benefit. For his retirement, we are saving money. Now, when the employee retires, he will withdraw the money from this RPF, guys. Now, when he withdraws this amount from the RPF, in such cases, this amount which he has withdrawn from RPF, this amount is generally taxable. The amount which he withdraws from RPF is generally taxable. However, there are some cases where it is exempt also. This is something which you would have learned in the salaries chapter is as well, that when you withdraw the money from RPF, generally it is taxable, but there are some occasions when it is exempt also. Don't worry, I will give you a revision of this as well from salaries head. It will be a good revision for you. I'll come to it point by point. So when the employee withdraws money from RPF, at that time for the employee, he's earned an income, guys. He's receiving money from RPF, he's having an income, and the source of this income for him is RPF. At the source, RPF will deduct tax. So RPF will become the deductor of tax and the employee will become the deductee of tax. Everybody is following? Now RPF will deduct tax at the time of payment. Guys, I'm saying at the time of payment. I'm not saying payment or credit, whichever is earlier. Where and all have you seen at the time of payment? See, what are the other sections that we have seen where we deduct tax at the time of payment? Number one, we have section 192, TDS on salary. Even here we deduct tax at the time of payment. Then we have section 192A now, RPF withdrawal, we are deducting tax at the time of payment. Then we have section 194B, your casual winnings, lottery winnings and all. 194BB, horse race winnings. In these sections also we deduct tax at the time of payment. Then remember we had learnt about section 194DA, maturity proceeds of life insurance policy. Even here tax is deducted at the time of payment. Then we had section 194LA, your compulsory acquisition section. Section 194N, cash withdrawals. In all these sections we have seen tax to be deducted at the time of payment. So under section 192A, when the employee is withdrawing amount from the RPF, at the time of payment, at the time of withdrawal, RPF will deduct tax at source. Alright. Now listen, only if this RPF withdrawal is taxable, only then section 192A TDS will apply. In simple words, if the amount which is withdrawn is exempt, then in that case, section 192A TDS will not apply. Are you all understanding? Is this crystal clear? Yes. So when does section 192A TDS apply? 192A TDS will apply only if the amount withdrawn from RPF is taxable. If the amount withdrawn from RPF is exempt, then TDS will not apply. Only if the amount withdrawn is taxable, only then TDS will apply. Now, what is the limit and at what rate will TDS apply? See, if the amount of withdrawal happens to be less than 50,000, there is no TDS. If it is equal to 50,000, then yes, we will have TDS at the rate of 10%. And if it is more than 50,000, here also we will have TDS at the rate of 10%. So what do you think? Is this a normal section or is this an abnormal section? Look at the limit and tell me, is this normal or is this abnormal? This is clearly abnormal, guys, because here even greater than or equal to, even equal to, we are deducting tax. Where else have we seen abnormal sections like these? Remember 194 IA, purchase of immovable property, at least 50 lakh we deduct tax. Then section 194 DA, your insurance proceeds, your maturity amount from the insurance policies, 194 DA. Even here we have the sign at least. If the amount of withdrawal is at least 1 lakh, if the maturity proceeds are at least 1 lakh, we deduct tax at source. Now we've seen one more abnormal section, section 192A, which is with respect to RPF withdrawals. Even here we deduct tax at source. If the amount of withdrawal is even equal to 50,000, even here we deduct tax at source. So yes, 192A is an abnormal section. So please keep in mind, only if the amount that I am withdrawing is taxable, only then under 192A we will deduct tax at source. If the amount which you are withdrawing is exempt, then we will not even deduct tax at source. Okay, now see, just to give you some revision, when is this amount exempt? See, number one, if the employee has rendered a continuous service of 5 years and after that if he's going to withdraw the amount, it's going to be fully exempt for him. Second situation, let's say for employer 1, the employee worked for 4 years, okay? He left employer 1 and then he joined employer 2. For employer 2, let's say he worked for 3 years. So individually, if you see, he has worked for less than 5 years. But what he did was, when he left from employer 1, whatever money he had in his RPF balance, he transferred it to employer 2's RPF. So basically, he's continuing to use RPF only. So RPF point of view, if you see, totally he has worked for 7 years, guys. RPF point of view, if you see, he has worked for 7 years, which is at least 5 years. So even though he has shifted employers, he did not withdraw money from RPF in between. Money stayed in RPF for at least 5 years. So even over here, later when he withdraws the money, it's going to be fully exempt. Third situation, let's say he has worked for less than 5 years. But I asked him what is the reason? Why did he leave in less than 5 years? The reason was something which is beyond the employee's control. For example, let us say the employer shut down his business. Now, if the employer shuts down his business, even if the employee wants to continue to work, is it even possible? No. So in such cases, even though he worked for less than 5 years, the amount of withdrawal which he is having from RPF will still be fully exempt, because yes, he worked for less than 5 years, but the reason was something which is beyond his control, guys. I'll give you one more example. Let's say the employee attracts some disability. He's now disabled. So if the employee is disabled, if he is suffering from a disability, now even though he wants to continue to work, he cannot work. He has to leave within 5 years because he's suffering from a disability. Now he cannot continue to work. So in such cases, yes, he worked for less than 5 years, but the reason was beyond his control. So in such cases, we will not in such cases also, we will exempt the entire amount withdrawn by the employee from RPF. Then coming to the next point, the last point, whatever balance was there in RPF, if that balance has been moved to NPS, from RPF we took out the balance and we put the balance into NPS, in such cases also the amount withdrawn from RPF will be fully exempt. So keep in mind, whenever the amount withdrawn from RPF is exempt, in those cases, it's going to be full. In those cases, there's going to be no TDS at all. Only if the amount that we withdraw from RPF is taxable, only then there will be TDS under section 192A. Crystal clear, everybody? So under section 192A, the RPF is going to be the deductor. RPF will deduct tax at the time of payment. If the amount of withdrawal is at least 50,000, they will deduct tax at the rate of 10% at the time of payment, but only if this withdrawal is taxable. In these 4 cases, if any of these 4 cases exist, then the amount that we withdraw is going to be exempt. If the amount withdrawn is exempt, then in that case, 192A will not apply. So 192A, we can say that a starting point is what? The amount has to be taxable. This is the starting point of 192A. Understanding, everybody? If the amount of withdrawal is not even taxable, you won't even think about 192A. So the starting point is that the amount of withdrawal has to be taxable. Only then you will apply TDS. And I've given you 4 situations where the amount is exempt. So in these 4 cases, because the amount of withdrawal is exempt, TDS under section 192A will not apply. Crystal clear, everybody? 2 sections we have learned. Section 194IB, which applies to rent, that rent which is not covered by section 194I. And now we have learned about section 192A, which talks about RPF withdrawals. Now let me take you to the next section. We're going to be discussing about 2 sections back to back, section 194 and section 194K. These 2 sections we will discuss simultaneously in the same page because more or less they are same, just a few differences. Under section 194, we have 2 people in the story. Number 1, we have a domestic company, and number 2, we have shareholder. The domestic company is paying dividend to the shareholder. Now see, this dividend can be any kind of dividend. It can be 222A dividend. It can be 222B dividend. It can be 222C dividend. It can be 222D dividend. It can be 222E dividend. It can be any category of dividend. This domestic company will deduct tax at the time of payment. They will deduct tax. Now see, we will always check here what is the mode of payment. How is the company paying this dividend to the shareholder? Is the mode of payment cash, or is the mode of payment any other non-cash mode? If the mode of payment is cash, then there is no limit. Irrespective of how much dividend is being paid, TDS will apply at the rate of 10%. Even if it's a small amount of dividend, still TDS at the rate of 10% will apply if the mode of payment is cash. But if the mode of payment happens to be non-cash mode, then what will you do? If the mode of payment happens to be non-cash mode, then there is a limit. Then we will see, is it less than 50, is it less than 5,000? If it is less than 5,000, there will be no TDS. Also, if it is equal to 5,000, also there will be no TDS. However, if it is more than 5,000, then there will be TDS at what rate? There will be TDS at the rate of 10%. We will have TDS. Crystal clear, everybody? This is section 194. So this was our discussion on section 194. Under section 194, we learned that if the domestic company is paying dividend to the shareholder, at the time of payment, the domestic company will deduct tax. The dividend can be any type of dividend, 222A, B, C, D, E. It can be any type of dividend. If the dividend is being paid in cash, irrespective of the amount, the tax is going to be deducted at source at the rate of 10%. But if dividend is being paid in any other non-cash mode, up to 5,000, there is no TDS. Only if the dividend is more than 5,000, only then tax will be deducted at the rate of 10%. This is about section 194. Now coming to section 194K. Now under 194K, we are talking about, on one side we have mutual fund or UTI, and on the other side we have the unit holder. See, let us say I have given some money to the mutual fund. Like me, multiple other people have invested money in mutual fund, and mutual fund is going to pull in all our money and is going to buy shares of other companies, guys. Then those other companies in which mutual fund is investing our money, they will give dividend to mutual fund. Mutual fund will keep some income with itself, and then it will pass on some of the income to the unit holders. So under section 194K, we are talking about the incomes which mutual fund or UTI passes on to its unit holders. So any income which mutual fund or UTI gives to its unit holders, for the unit holder, it's going to become an income. So they will. So for them, the source of the income is mutual fund or UTI. So mutual fund or UTI will deduct tax at source when they will deduct tax at source at the time of payment or credit, whichever is earlier. Here we don't have this concept of mode of payment at all, because mutual fund or UTI will anyways not pay this income in cash mode. It will anyways be in non-cash mode only. So we don't even have to talk about the mode of payment. I'll straight away put the same thing over here once again. If the amount is less than 5,000, then there will be no TDS. If the amount is equal to 5,000, also no TDS. Only if the income is more than 5,000, only then we will have TDS. At what rate? TDS will be at the rate of 10%. Understanding, everybody? So two sections we have learned over here back to back. Our first section was section 194. Under section 194, we are talking about dividend. Dividend, it can be any type of dividend. If you are paying it in cash, irrespective of the amount, the company will deduct the tax at source at the rate of 10%. But if the mode of payment is any other non-cash mode, then only if it is more than 5,000, only then 10% tax will be deducted at source. Then here we learned about mutual fund or UTI. When they give any income to the unit holders, up to 5,000, no TDS. Only if it is more than 5,000, only then TDS will apply. TDS will be at what rate? TDS will be at the rate of 10%. Alright, everybody. So here again we have learned two more sections, section 194 and section 194K. So in this session, if you see, we've covered 194IB, TDS on rent, which is not covered by section 194I. We've spoken about 192A, which talks about RPF withdrawals, and we've discussed about section 194 and 194K as well. Now I'll take you to the next section. Let me take you to the next section now, which is section 193. Now, section 193 talks about interest on securities. See, do you remember we have already learned about section 194A, right? 194A covers interest other than interest on securities. So, if the assessee, if I earn interest income which is relating to securities, then tax will be deducted under section 193. If I'm earning interest income which is not from securities, then it will go to section 194A. So 194A, we've already learned interest other than interest on securities. Now we're learning section 193, which is about interest on securities. Now let's say there are two people, all right. We have this person, Mr. Blue. This is, let's say, an issuer of securities. And there is this person, Mr. Green. Let's say two people in the story, Blue and Green. Now, this Blue, let's say Blue Limited, has issued some securities to Green. Securities, for example, let's say debentures or bonds, and of course, against this, Green is going to pay for the securities, guys. Nobody's going to get securities for free. So, of course, Green is going to pay for the securities, right, guys? Now, with respect to these securities, Blue will give interest to Green, right? And this interest becomes an income for Green, and for Green the source of the income is this issuer. So at the source, tax is going to be deducted, so Blue will become the deductor of tax and Green will become the deductee of tax. All right, guys. So point number 1, under section 193 we're talking about interest on securities. Under section 193 we have on one side the issuer of securities, that is the person who has issued the securities, and on the other side we have the person who has invested in the securities. Now, like for example, let's say this is Blue Limited, and let's say Blue Limited has issued some debentures to Green. Now, of course, Blue Limited is going to pay interest on these debentures to Green. So this becomes interest on securities, and this is what I am covering under section 193. Under section 193, the deductor will deduct tax at the time of payment or credit, whichever is earlier, just like any other normal section. When will we deduct tax? At the time of payment or credit, whichever is earlier. Okay. Now listen, however, this issuer of securities should not be the government. Government as in should not be central government, should not be the state government. Neither central government nor state government, which itself automatically indicates that if these are government securities, then section 193 will not apply, because the issuer should not be the government or should not be the government, neither central government nor state government. So if they are government securities, then the issuer will be government, so 193 will not apply. And number 2, it should also not be a government company. Understanding? So we have 2 exceptions. The issuer should neither be the government nor should be the government company. Now listen, there are some more situations where section 193 is not applicable. If these securities happen to be national development bonds, if these securities are national development bonds, section 193 will not apply. Also, if the securities happen to be NSE 4th issue, section 193 will not apply. If these securities, if these bonds happen to be section 54 EC bonds, see, under 54 EC, we have 4 bonds, right? We have NHAI bonds, we have REC bonds, we have Power Finance Corporation of India bonds, and we have IRFC bonds. 4 bonds we talk about under section 54 EC, capital gains, guys. Now, under section 193, if they are PFCI bonds or if they are IRFC bonds, then tax will not be deducted at source. So, I'm talking only about 2 of them in the exclusions. If the bonds happen to be PFCI bonds or IRFC bonds, then section 193 TDS will not apply. Then, if they are government securities, then also section 193 TDS will not apply. This I have already spoken to you about over here. Then the next point, if the securities happen to be debentures, okay, these debentures may either be listed debentures or they may be unlisted debentures. So securities are debentures, listed or unlisted debentures, and these debentures are issued by a widely held company. You know what a widely held company is? A company in which public is interested. The debenture holder happens to be either an individual or a HUF. This debenture interest is being paid by way of account payee check only, and the amount of the debenture interest is within 5,000. If all these conditions are fulfilled, then again section 193 will not apply. What are the conditions, guys? Number 1, the securities have to be debentures. These debentures may be listed debentures or they may be unlisted debentures. These debentures must belong to a widely held company. The debenture holder should be individual or HUF. The debenture interest should be paid by way of account payee check and should not exceed 5,000. If all these conditions are fulfilled, then section 193 TDS on interest on securities will not apply. Okay, then listen to the next point, one final point. If the securities happen to be either 6.5% gold bonds or if they happen to be 7% gold bonds, 6.5% gold bonds or 7% gold bonds, in such a way that the aggregate face value of these bonds which are held by the security holder, the aggregate face value of these bonds should be within 10,000. If it is within 10,000, then there is no TDS. Please note, I'm not saying that the interest has to be within 10,000. I'm saying what is the face value of the bonds held by this person, that should not be more than 10,000. If all these conditions are fulfilled, then section 193 will not apply. Understanding, everybody? That's all, guys. Very simple section 193, interest on securities. Under section 193, we're talking about interest on securities. If it is interest other than interest on securities, like if it is FD interest or if it is interest on loan, all that will come to section 194A. But if it is interest on securities like debenture interest, interest on bonds, all of that will come under section 193. The deductor will deduct tax at the time of payment or credit, whichever is earlier. The issuer of securities should not be the government, should also not be the government company. The bonds should not be national development bonds, should not be NSE fourth issue, should not be 54 EC bonds like PFCI bonds and IRFC bonds, should not be government securities. Also, the security should not be fulfilling these conditions. If any of these conditions are fulfilled, then section 193 is not applicable. If the securities are debentures, listed or unlisted debentures belonging to a widely held company held by an individual or a HUF, interest is paid by account payee check within 5,000 rupees. If all these conditions are fulfilled, then section 193 TDS on interest on securities will not even apply. All of the securities are 6.5% gold bonds or 7% gold bonds, and if the aggregate face value held by this person is within 10,000, then also section 193 TDS will not apply. Simple, guys. They are all independent situations. If any of these situations are applicable, then section 193 TDS will not apply. Crystal clear, guys. This government security points is extremely important. Government security, no TDS under section 193, and also this point is very important. If the securities are debentures, listed or unlisted debentures of a widely held company, and the debenture holder happens to be an individual or HUF, debenture interest is paid by account payee check and not exceeding 5,000. If all these conditions are fulfilled, under section 193, tax will not be deducted at source. Perfect clarity, everybody? Yes, so this is it about our discussion on section 193 also. Our next section now is section 194P. See, we're left with three sections, 194P, 194Q and 194R. These three sections we're left with. Now, these three sections, once we're done with them, we'll have to learn about some extra points, like for example, the due dates for paying TDS, the due date for filing TDS return, the due date for giving TDS certificates. Then we'll have to learn about 206W, 206AB. So we'll have some extra points as well. Let us finish off 194PQR first. Under section 194P, I'm talking about a very specific situation, okay? Here the deductor happens to be a specified bank. The deductor happens to be a specified bank, and the specified bank is none other than a scheduled bank. Alright. Specified bank, nothing but a scheduled bank. Alright. Now the deductee happens to be a specified senior citizen. See, I'm not saying just senior citizen. I'm saying specified senior citizen, so which means it's going to be slightly different. Now, who is a specified senior citizen? Let's discuss. A specified senior citizen is a person who fulfills multiple conditions. Condition number 1, he has to be an individual, of course. Condition number 2, he is a resident. Condition number 3, he is at least 75 years old. See, generally, when I say senior citizen, we talk about at least 60 years old, right? But however, under section 194P, we are talking about a specified senior citizen has to be at least 75 years old. Condition number 4, he is having pension income. Now, this pension income is being credited for him in this bank account. Basically, in this scheduled bank, this specified senior citizen has a bank account. And in that bank account, this pension income is getting credited. Alright. Apart from pension income, this specified senior citizen is not having any other income. See, there's only one exception to this rule. He is not having any other income. There's only one exception to this rule. The maximum he can have interest income. Now, interest income, what kind of interest income? See, we're talking about bank interest income. It can be either FD interest income or RD interest income or even savings account interest income. But this interest income also has to be from the same bank only. Understanding. See, do not misunderstand this. Alright. This pension income is mandatory. The assessee must be having pension income. Pension income is mandatory. But this interest income is not mandatory. I said that the assessee should not have, the specified senior citizen should not have any other income. If at all he has any other income, at the maximum it can be only interest income. So interest income is not mandatory. It's not mandatory that the specified senior citizen should have interest income. What we are saying is, if at all he's having any other income, it can be only interest income. But even that interest income has to be from the same bank only. This is your fifth condition. And the sixth condition is that the specified senior citizen has given a declaration saying that all these conditions are fulfilled. If all these conditions are fulfilled, then only the person becomes a specified senior citizen. Understanding? So under section 194P, the deductor happens to be a specified bank. The deductee happens to be a specified senior citizen. Who is a specified senior citizen? Condition number 1, he's an individual. Condition number 2, he's a resident. Condition number 3, he's at least 75 years old. Condition number 4, he's mandatorily having pension income. Condition number 5, he does not have any other income. If at all he has any other income, at the maximum it can be only interest income. Interest income also should be from the same bank only. If he is earning this interest income from some other bank, then he will not be specified senior citizen. Like for example, if pension income is being credited in my HDFC bank account, but I'm having FD in ICICI bank and I'm earning interest from ICICI bank, I will not be specified senior citizen. Because specified senior citizen, two important conditions are that my pension income is credited in one bank account. In that same bank only I must be earning interest income also. If I'm earning interest income from some other bank, then section 194P will not apply. Understanding everybody? Yes. So under section 194P, the deductee has to be a specified senior citizen fulfilling 6 conditions. If all these conditions are fulfilled, if section 194P is applicable, then the whole responsibility is on this specified bank. The whole responsibility is on this scheduled bank. This scheduled bank will sit and calculate the GTI of the specified senior citizen. The GTI will have only 2 components, guys. This pension income and this interest income. So they will compute GTI of the specified senior citizen. From this, they will let the senior citizen enjoy chapter 6 deductions, whatever is applicable, and the total income of the specified senior citizen will be computed. Who will be doing all this computation? Not the specified senior citizen, not the assessee himself, but the bank will be doing all this calculation. On this total income, what is the tax liability? The bank will sit and calculate. Against this tax liability, the bank will enjoy 87, the bank will let the senior citizen avail 87A rebate. The bank will add surcharges if applicable, consider marginal relief, consider cess. After all this, they will find the tax liability of this particular specified senior citizen. Now, the specified senior citizen is having only 2 incomes, pension income and interest income. Pension income will come under the salaries head, guys. So, against pension income, section 192 TDS might have been deducted. So, 192 TDS credit will be availed. Similarly, against this interest income, this is interest from FD, RD and all, section 194A TDS might have been deducted. So if any 194A TDS has been deducted, even that credit will be availed. Whatever is our net number, this is the amount that will be deducted as section 194P TDS. This will be section 194P TDS. And one very important point, remember, if the banker is deducting this amount as section 194 PTDS, then this specified senior citizen need not even file his ITR. No need to file ITR at all. That's all. Very simple section. This was section 194P. Understanding everybody, I'll repeat once again. Under section 194P, the deductor happens to be a specified bank. The deductor happens to be a specified senior citizen. Specified senior citizen means condition number 1, you are an individual. Condition number 2, you are a resident. Condition number 3, you are at least 75 years old. Condition number 4, this person is mandatorily having pension income. Mandatorily he is having pension income. Condition number 5, he is not having any other income. At the maximum, he can only have interest income, that too from the same bank where the pension income is credited. And condition 6 is given a declaration saying all these conditions are fulfilled. If all these conditions are fulfilled, section 194P will apply. Under section 194P, the scheduled bank will compute this person's GTI. The GTI will have only two components, guys, this pension income and this interest income. Then they'll avail chapter 60 deductions, we'll get the total income number. On this total income, tax liability will be computed. The normal usual tax liability calculation will be done. Whatever TDS credit is available, we'll avail all that, and whatever is the balance tax liability of the specified senior citizen, that balance tax liability will be deducted by the specified bank. If section 194P is applicable, if the deductor is deducting so much tax under section 194P, then the deductee, the specified senior citizen, need not even file his income tax return. Getting it? This is section 194P. If you noticed, even under section 194P, we're going to compute tax liability and all on the basis of slab rates, right? In which other section do we compute TDS on the basis of slab rate? Even in 194P, the specified bank is going to use normal slab rates to do these calculations, right? So which other section do we use slab rates in TDS? Section 192. TDS on salary. Even there we compute tax on the basis of slab rate. So even section 194P, we will deduct tax on the basis of slab rates. Even section 192, we will deduct tax on the basis of slab rates. Crystal clear? This was section 194P for you. Remember, specified senior citizen, at least 75 years old, should have pension income. At the maximum, any other income, at the maximum, only interest income he can have, that too from the same bank only. And remember, if tax is deducted under 194P, then the deductee need not even file his ITR. This was section 194P, guys. Now I am taking you to our next section, which is section 194Q. Let me discuss this with you. Section 194Q is a very important section, guys. Under section 194Q, we're talking about TDS with respect to goods, okay? So basically what happens is, see, we have two people in the story over here. We have the buyer and we have the seller. The seller is selling goods to the buyer. Now the buyer is going to pay the price to the seller, guys. From the price, the buyer will deduct the tax at source, and only the balance is what the buyer will give to the seller. You're understanding? So section 194Q is TDS with respect to goods. So when the buyer is paying the price for the goods, against the price, the buyer will deduct the tax and will pay only the balance. So the buyer will become the deductor of tax and the seller will become the deductee of tax. A slightly different section, multiple conditions, I'll discuss them with you one by one. Point number one, who is the deductor over here? I've already told you, the deductor happens to be a buyer. Now this buyer can be any person, can be an individual, can be a HUF, can be a partnership firm, can be an LLP, can be a company, can be AOP, BOI, AGP, can be any person, just that their preceding previous year turnover has to be more than 10 crore. See, generally we talk about turnover more than 1 crore, gross receipt more than 50 lakhs in the R hijack sections, but that is only for individual and HUF deductors. But under 194Q, first of all, not 1 lakh turnover, I'm talking about not 1 crore turnover, I'm talking about 10 crore turnover. And secondly, the deductor can be any person. I'm not talking about just individual or HUF. I'm covering them all. So under section 194Q, the deductor has to be a buyer. The buyer may be individual, HUF, partnership firm, LLP, any kind of person, just that the preceding previous year turnover has to be more than 10 crore. Condition number two, who is the deductee? The deductee should be the seller, guys. Of course, the deductee is a seller. I've already told you about that as well. Okay, so point number one, the deductor has to be a buyer. The buyer can be any person, individual, HUF, firm, LLP, doesn't matter. Just like preceding previous year turnover has to be more than 10 crores. The deductee will be the seller. First two conditions clear. Tax will be deducted at the time of payment or credit, whichever is earlier, normal section. But then when will tax be deducted? For small purchases and all, we will not apply section 194Q. We will apply 194Q only if between this buyer and seller, if the aggregate amount of purchase between this buyer and seller is more than 50 lakhs. Only if it is more than 50 lakhs, only if this aggregate price, the aggregate goods sold between the seller and buyer is more than 50 lakhs, only then section 194Q will apply. Now see, when you're calculating this 50 lakhs number, are you going to include GST or are you going to exclude GST? See, a general rule is in TDS discussions, we exclude GST, guys. We don't consider GST. But 194Q is slightly different. See, we will have to see what exactly is earlier. Is payment earlier or is credit earlier? We just said, right, that we will deduct tax under 194Q at the time of payment or credit, whichever is earlier. So we will see which is earlier. Is payment earlier or is credit earlier? See, if payment is earlier, it means it's like advance payment is being made. Only then payment will be earlier. So if payment is earlier, then in that case, we will include the GST component also. But however, if credit is earlier, then we will exclude the GST component. Understanding? So when you're calculating this 50 lakh number, when you're seeing what's the total purchase between this buyer and seller, what's the total transaction between these two parties, when you're checking, should you include GST or not? It depends upon what is earlier. Is payment earlier or is credit earlier? If payment is earlier, then we will include GST. If credit is earlier, then we will not include GST. Understanding, everybody? If payment is earlier, then yes, we will include GST also. If credit is earlier, then we will not include GST. So we'll have to see each transaction one by one, which is earlier, and accordingly we will have to include GST sometimes, exclude GST at other times. If all these conditions are fulfilled, under 194Q, we will deduct tax at the rate of 0.1% of the excess. Excess as in, for purchase up to 50 lakhs, there is no TDS. If the purchase is, let's say, 60 lakhs, then the excess is 10 lakhs. On that 10 lakhs, we will deduct tax at the rate of 0.1%. See, even this is a unique section. I am asking you to deduct tax only on the excess. Generally, you don't find this in TDS sections, right? Generally, if the amount exceeds a limit, on the entire amount we deduct tax. But under section 194Q, we will deduct tax only on the excess. Which other TDS section have you learned where we deduct tax only on the excess? Do you remember section 194N? TDS on cash withdrawals. Even over there, we deduct tax only on the excess, guys. So under section 194Q also, we will deduct tax only on the excess above 50 lakhs at a very small rate, 0.1%. Okay, then discussing with you some extra points with respect to 194Q. If this year happens to be the first year for the buyer, if this is the first year, if for the buyer's business, if this is the first year of the buyer's business, then do you agree we do not have a preceding previous year? We do not have preceding previous year, guys. So preceding previous year turnover more than 10 crore will not be fulfilled. This is the first year of the buyer's business. We don't have a preceding previous year. So if it's the first year, section 194Q will not apply. You understood the logic why it will not apply, because we anyways don't have preceding previous year at all. 194Q will apply only if the buyer's preceding previous year turnover is more than 10 crores. But if this is the first year of the buyer's business, he doesn't even have a preceding previous year. This condition itself will not be fulfilled. Therefore, section 194Q will not apply. Okay, then listen, if the deductee does not give his PAN also, does not give his Aadhaar also, then which section do you apply? He's neither giving PAN nor giving Aadhaar. You apply 206AA, guys. Right? Now, what does 206AA say? 206AA says that the TDS rate will change into 20% or whatever is the applicable rate of that particular section, whichever is higher. Right? But however, there's one small catch. If we are talking about section 194Q, under section 194Q, instead of 20%, you will take it as 5%. Are you understanding? If it is section 194Q, instead of 20%, you will take the 5% number. So under section 194Q, if you see, if I have to summarize, if I have to summarize 206AA, Alright, 206AA, generally what does 206AA say? 20% or whatever is the applicable rate, whichever is higher. But if 206AA plus 194Q is applicable, then it's going to be 5% of whatever is the applicable rate, whichever is higher. Understanding? So 206AA, generally the upper limit is 20%, but under 194Q, the upper limit will become 5% only. Then listen to the next point. If the transaction is happening on the stock exchange, that is, if the transaction is with respect to purchase and sale of shares on the stock exchange, then in that case, section 194Q will not apply. Transactions happening on the stock exchange, 194Q is not applicable. Then listen to one another point. If any other TDS section is applicable, then section 194Q will not apply. If any other TCS section is applicable, then also section 194Q will not apply. But however, if TCS in the form of 206C1H is applicable and 194Q are also applicable, between these two sections, you will give priority to 194Q. So I'll help you understand a little better. Let us say some other TDS section is applicable, alright. Some other TDS level, like for example, let's say section 194O is applicable. 194O is not a part of your intermediate syllabus anymore, but 194O is the only other section which talks about goods. So let's say section 194O is applicable and section 194Q is applicable. Between these two sections, you will give priority to 194O, because if any other TDS section is applicable, then 194Q will not apply. If 206C1 is applicable and section 194Q is applicable, 206C1 is a TCS section, guys, you will be aware of it. So if any other TCS section is applicable, you apply that. I will not apply 194Q. So if any other TDS section is applicable, you apply that. If any other TCS section is applicable, you apply that. However, if TCS 206C1H is applicable and 194Q is applicable, between these two sections, we give priority to 194Q. So I can say that 194Q is going to override all other TCS sections except 206C1. I can say 194Q will be, 194Q is a weaker section. All other TCS sections will override 194Q, but 194Q will override 206C1H. So all other TCS sections except 206C1H, all TCS sections except 206C1H will override 194Q. 194Q will override 206C1H. If any other TDS section is applicable, you apply that. If any other TCS section is applicable, you apply that. But if 194Q and 206C1H, if these two sections are applicable, between these two sections, you will always choose section 194Q only. Understanding, everybody? So this was a very, very important discussion with respect to section 194Q. Now listen, if I have to summarize section 194Q, you can summarize it into three simple conditions, guys. Condition number 1, the buyer should be a person whose preceding previous year turnover is more than 10 crore. Condition number 2, no other TDS should apply, no other TCS should apply. Condition number 3, by the way, do not forget, no other TCS should apply, but however, if 206C1H and 194Q is applicable, between these two sections, 194Q only you will give priority. This one exception you are aware of. Third condition is that the aggregate transactions between these two parties has to be more than 50 lakhs. When you're doing this aggregate transaction, if payment is earlier, then you will include GST. If credit is earlier, then you will not include GST. So I have three conditions. If all these three conditions are fulfilled, then section 194Q will apply. Under 194Q, we will deduct tax at the rate of 0.1% of the excess. 0.1% of the excess. When will we deduct tax? At the time of payment or credit, whichever is earlier. So this is a very simple form of learning this section. The buyer should be a person whose preceding previous year turnover is more than 10 crore. No other TDS should apply, no other TCS should apply. The aggregate transaction has to be more than 50 lakhs. If payment is earlier, you will also include GST. If credit is earlier, you will not include GST. If all these conditions are fulfilled, section 194Q will apply. Under section 194Q, we will deduct tax at the rate of 0.1%. 0.1% of what? 0.1% of the excess above 50 lakhs. And when will we deduct tax, guys? We will deduct tax at the time of payment or credit, whichever is earlier. Understanding section 194Q. Buyer can be any person, just like preceding previous year turnover should be more than 10 crore. You will deduct tax at the time of payment or credit, whichever is earlier. If payment is earlier, you will include GST component also. If credit is earlier, you will not include the GST component. You will deduct tax at the rate of 0.1% of the excess. Under 206AA, instead of 20%, you will take the 5% number. If any other TDS is applicable, 194Q will not apply. If any other TCS is applicable, then also 194Q will not apply. But if 206C1H TCS is applicable, between these two sections, 194Q only will have priority. Understanding? So this was our entire discussion with respect to section 194Q, a very important section. Understanding, guys. Now, apart from this, only one more TDS section we are left with, and that is section 194R. Taking you to the next section now, which is section 194R. Section 194R is one of the recent sections introduced in TDS, a very interesting section. Under 194R, let me straight away give you the diagram to help you understand what exactly happens over here. Let's say we have two people. We have this person, Mr. Blue, and we have this person, Mr. Green. Okay. Now, this Mr. Blue has given to Mr. Green some benefit or some perquisite. Some benefit or some perquisite. This benefit, this perquisite doesn't matter. It may be in cash or it may be in kind. It may either be in cash or it may be in kind, but it has to be related to the business or profession of Green, the recipient basically. Okay, so what are your conditions? Condition number one, there is this person, Mr. Blue. He has given to Green a benefit or perquisite which is in cash or in kind, and this benefit or perquisite is relating to the business or profession of Green. Now, for Green, he's getting a benefit or perquisite relating to his business. So it's of course an income for Green, right? Green is earning some benefit or perquisite. He is receiving some benefit or perquisite. It is related to his business or profession. So it will obviously come under PGBP head. It's a business income or a professional income for Green because this benefit or perquisite is related to his business or profession. So Green is earning an income over here, and the source of this income is Mr. Blue. So at the source, tax is going to be deducted. So Blue will become the deductor of tax and Green will become the deductee of tax. Now, this Mr. Blue will deduct tax before giving this benefit, before giving this perquisite, before providing the benefit, before providing the perquisite, he will deduct tax at source. Now listen, at what rate will he deduct tax at source and what are the limits? See, we will have to see what is the value of this benefit or this perquisite. We'll have to find the value. If the value happens to be less than 20,000 rupees, then there is no TDS. If the value happens to be equal to 20,000 rupees, then also there is no TDS. Only if the value of this benefit or perquisite is more than 20,000 rupees, only then we will have TDS at what rate? TDS at the rate of 10%. So the TDS is going to be at the rate of 10%, but when? Only and only if the value of the benefit or the perquisite is more than 20,000, then we will deduct tax at the rate of 10%. Alright, now listen, if the benefit happens to be in kind, there are some extra points if the benefit happens to be in kind. Like for example, let us say this Mr. Blue is, let's say, ITC Limited. Okay, ITC Limited and Green is, let's say, some stationery shopkeeper. So ITC Limited has told the stationery shopkeeper that you sell 1,000 books of 1,000 classmate notebooks you sell during the month. I will give you one free gold coin. I will give you. So this Mr. Green, the stationery shopkeeper, he has sold 1,000 classmate notebooks during the month. Now ITC is going to give him a gold coin. Now don't you think this gold coin for Mr. Green is a benefit or a perquisite? It is in kind and it is relating to his business or profession. He is getting this gold coin because the stationery shopkeeper sold 1,000 classmate notebooks. So totally connected to his business or profession. So these kind of transactions will come under section 194R. So before ITC Limited can deliver the gold coin, before delivering that, tax has to be deducted at source at the rate of 10%. if the value of the gold coin is more than 20,000 rupees. Now see, in my example, the benefit is in kind. If the benefit is in kind, how will tax be deducted at source? How will we keep some money and give the balance? See, if the benefit is in cash, if the benefit is in money, we can keep a part of the money and give the balance money. But if the benefit is in kind, how will we deduct the tax? If the benefit is in kind, then in that case, the deductor will ensure that the tax is paid. He will ensure that the tax is paid by the deductee. He will ensure either the deductee has paid the amount or the deductor himself will bear the tax. He will ensure that tax is paid on this benefit or perquisite. Only then he will release this benefit in kind. If it is a benefit in kind, he will ensure that the tax is paid. Only then he will release the gift, or he'll release a perquisite. Okay. Now see, section 194R. Even this is an R hijack section. R hijack sections, you remember, right? We have a common point. The common point is all about the deductor. Either the deductor will be an individual or HUF, or the deductor will be any other person. If the deductor happens to be an individual or HUF, we are covering only those individuals and HUFs whose preceding previous year turnover is more than 1 crore or their preceding previous year gross receipt is more than 50 lakhs. If the deductor happens to be any other person, we don't even care about the turnover and the gross receipt number. Only if the deductor happens to be an individual or HUF, only then we will look at the turnover and gross receipt number. Okay, then listen, one more point. You will be wondering, if the benefit happens to be in kind, how will we find the value of the benefit? Because if the value of the benefit is more than 20,000, only then we deduct tax. So how will we know what is the value of the benefit if the benefit is in kind? It depends. We will see, did he purchase the gold coin, or is he himself a manufacturer of the gold coin? If he has purchased it, then we will consider the purchase price. That will be the value of the gold coin. But if he has himself manufactured it, then we will see what is the amount charged from the customers. If he has himself manufactured it, then we will see that the same thing, had he sold to his customers, for how much he would have sold to the customers. How much amount would he have charged from the customers? That is what we will consider. Understanding, everybody? Yes, so till here I'll give you a revision. We have a lot more points to discuss under section 194R. Till here, let me give you a revision first. So under section 194R, there is a person, he is giving a benefit or a perquisite in cash or in kind related to the business or profession of the recipient. So for the recipient, it's some benefit which he is getting relating to his business or profession. So it's PGBP income, it's business income, professional income for this person. The source of this income is this person, Mr. Blue, over here. So at the source, tax is going to be deducted. Before giving the benefit or the perquisite, tax is going to be deducted if the value of the benefit is more than 20,000. If the value of the benefit is more than 20,000, only then tax is going to be deducted at the rate of 10% under section 194R. Then we said 194R is an R hijack section. So therefore, you will have this criteria about preceding previous year turnover and gross receipts. Then we learned that if the benefit happens to be in kind, then the deductor will ensure that the tax is actually paid by the deductee. Only then he will release the benefit or the perquisite. And if the benefit happens to be in kind, then how will we find the value? Whether it is less than 20,000, more than 20,000, how will we find? It all depends upon whether this person has purchased the gold coin from the market or has he himself manufactured it. If he has purchased the benefit or the perquisite, we will see what is the purchase price. If he has himself manufactured it, then we will see, had he sold it to his customers, how much amount he would have charged from the customers. That is a value that we will consider. This is the initial part of section 194R. Now we have some extra points under 194R. Let's consider them one by one. Under section 194R, when you are finding the value of the benefit of the perquisite, will you include GST also? Will you also consider GST? The answer is no. In all the TDS sections, if you see, you do not consider GST anywhere except in section 194Q, that too only if payment is earlier. All the other TDS sections, nowhere we consider GST. Then listen to the next point. See, if the benefit, can I say that if the benefit or the perquisite is taxable for green, if it's taxable for green under section 28 clause 4, in the PGBP head, only then tax will be deducted under section 194R, which means if the benefit or perquisite is not taxable for green under section 194 under 28.4, then 194R will not apply. Should I say that? Is that right? Should I say, is it right to say that if the benefit or perquisite is not taxable for green under 28 clause 4, then 194R will not apply? Should blue check this? Should blue check whether this benefit or perquisite will be taxable for green under 28 clause 4? The answer is no. You need not even check this. Whether the benefit or perquisite is taxable for green under 28 clause 4 or not does not even matter. See, 28 clause 4 is nothing but the section which says that if you receive any benefit or perquisite relating to your business or profession, it will be taxed under the head PGBP. That is what 28 clause 4 says. But Mr. Blue does not even have to check all that. For Mr. Blue, there are only 3 conditions. He is giving a benefit or a perquisite either in cash or in kind, and it is relating to the business or profession of the recipient. As soon as these 3 conditions are fulfilled, welcome to 194R. Blue does not have to take the headache of checking whether this benefit or perquisite is taxable for green under 194 under 28.4 or not. Whether it is taxable under 28.4 for green or not doesn't even matter. Blue will have to deduct tax under 194R if all these conditions are fulfilled. Understanding, everybody? Then listen to the next point. Can this benefit or perquisite, as a case may be, can it be a capital asset? Like, for example, can it be a car? Or let us say, can it be a piece of land? Can it be plant and machinery? Can it be a capital asset? Yes, it can be a capital asset also. It can be in money also. It can be in cash. It can be in kind. It can also be a capital asset. It does not matter. Then listen to my next extra point under section 194R. Let us say there are 2 people in the story. We have green on one side, and on the other side, let us say we have a bank. Okay, now this bank had given a business loan to Mr. Green. This loan was with respect to his business or profession. But Mr. Green, he is unable to repay the business loan. Because he is unable to repay the business loan, the banker is waiving off the business loan. The bank is saying no need to repay the business loan. I am waiving off the business loan. No need to repay. Now, do you agree this waiver of business loan means Green does not have to repay his business loan? So, of course, Green has enjoyed some benefit or perquisite, guys. And this benefit or perquisite, of course, it is related to his business or profession because a business loan is waived. So, of course, his benefit is relating to his business or profession. And this benefit is taxable under section 28 clause 4 for green. But however, this is a special scenario wherein section 194R TDS will not apply. So section 194R TDS will not apply to bank waivers, to loan waivers. Section 194R will not apply. Yes, no doubt, it is a benefit or perquisite. It is a benefit or perquisite relating to the business or profession of this person. Come on, he doesn't have to repay his business loan. Of course, it is a benefit for him. Of course, it is a benefit relating to business or profession. And even under 28 clause 4, it is taxable for him. But still, section 194R TDS will not apply in this particular situation. Okay, guys, then listen to the next point under section 194R. If there is a brand, all right, and if this brand is sending products to influencers, nowadays you have these Instagram influencers and all these social media influencers who get free products from the brand. The brand tells them that you make 2 reels, you put 1 story, you make 1 Instagram post, I'll send the product to you. So the influencer is receiving products from the brand. Now, if the influencer has to return the product after the reel is made, if the influencer has to return the product, then tell me, for the influencer, is it a benefit, guys? For the influencer, it is not a benefit, isn't it? Because come on, he has to return the product. So if he has to return the product, it's not a benefit for him. If it is not a benefit for him, section 194R will not apply. But however, if he does not have to return the product, then it is clearly a benefit for him, guys. He got the product for free. He will simply make the reel, he will make the Instagram story, and then he will keep the product. That's a huge benefit for him. So in such case, yes, section 194R will apply. So with respect to social media influencers, will section 194R apply or not? It depends upon, will the influencer return the product or will he not return the product? If the influencer is going to return the product, then the influencer did not enjoy any benefit. If he did not enjoy any benefit, then 194R will not apply. But however, if the influencer is not going to return the product, that is, he is going to keep the product with himself, then of course he is getting a benefit. Then yes, section 194R also will apply. Understanding, everybody? This is also clear. Yes. Now listen, I'm taking you to the next extra point under section 194R. Let us say we have the company and the share trader. Okay. Now company gives this share trader some bonus shares. Now this person over here is a share trader. His business is buying and selling shares. He is getting shares for free. He is getting bonus shares. Of course, it is a benefit or a perquisite relating to his business, guys. It is his business to buy and sell shares, and he's getting free shares. Yes, it is a benefit relating to his business or profession, but section 194R is not applicable on bonus shares. Similarly, even with respect to rights shares, the share trader is going to get rights shares for a discounted price, right? Rights shares are generally given at a price which is below the market price. So even there, the share trader is getting a benefit. He's getting a discount against the market price. But with respect to bonus shares, with respect to rights shares, in both section 194R is not applicable. Also, section 194R will not apply to sales discount. If any sales discount is being provided, if any cash discount is being provided, if any rebate is being provided, yes, all of these are, benefits or perquisite connected to your business or profession. But section 194R will not apply. See, 194R, I'll tell you examples of, cases where 194R applies. Like if you meet targets, many a times what happens is, like for example, let's say ITC in my example had given a target that if you sell 1,000 classmate notebooks in this month, I'll give you a free gold coin, or let's say I'll give you a free ticket. I'll sponsor your holiday. I'll sponsor your holiday to Japan. You sell so many notebooks, I'll give you a free travel ticket. All these kind of benefits come under section 194R. Bonus shares, rights shares will not come under 194R. Sales discount, cash discount, rebate, even this will not come to section 194R. Now listen to one last point under section 194R. I want to discuss this whole section with you full-fledged. So listen to this last point very carefully. Same two people in the story, guys. We have this person, Mr. Blue, and we have this person, Mr. Green. Let us say Mr. Blue had given to Mr. Green a mobile phone. Okay, Mr. Green had fulfilled some benchmarks, had fulfilled some targets, and Mr. Blue gave Mr. Green a mobile phone. Okay, this is clearly a benefit or a perquisite which Blue is giving to Green. And it is also related to the business or profession of Green, guys. Alright, now if you see this Mr. Blue, he will deduct tax. It's a benefit or perquisite in kind relating to business or profession of the recipient. So if the value of this mobile phone is more than 20,000, then Mr. Blue will deduct tax under section 194R. He will deduct tax, guys. There will be TDS. Now, if you look at Green's point of view, for him, this mobile phone is going to be taxable under section 28 clause 4. It is of course going to be taxable, no? Because benefit or perquisite relating to his business or profession. So whatever is the FMV of this mobile phone, it will be taxed for him under section 28 clause 4. Now listen, till here nothing new. Now listen, what if Mr. Green starts using this mobile phone for his business or profession? Then he will ask for depreciation, guys. He will want to claim depreciation. Now, how do you claim depreciation? Only when you add the asset to the block, add actual cost of assets acquired. Only when you add the asset to the block, only then you claim depreciation. So when you're adding the asset to the block, at what value will you add it to the block? Because it is in kind. So at what value will you add it to the block? See, whatever was taxable for him under section 28 clause 4, at that value only it will enter the block. understanding. So here what multiple points I told you in this particular point. First of all, I told you Mr. Blue will deduct tax under section 194R. Here no confusion. For Mr. Green, if you see it's a benefit or a perquisite relating to business or profession. So under 28 clause 4 PGBP, it will be taxed for Mr. Green, the value of the mobile phone. Whatever amount is taxed under 28 clause 4, that amount only will enter the block to claim depreciation. That same amount which is taxable under 28 clause 4, that amount only will enter the block. So on that same amount only you will claim depreciation also. Alright, so this is it about our entire discussion with respect to section 194R. All clear, everybody? Under section 194R, Blue is giving to Green a benefit or perquisite either in cash or in kind related to the business or profession of Green. If it is in kind, Blue will ensure tax is paid, only then he will release the gift. If the benefit happens to be in kind, how will you know what is the value of the benefit? If Blue has purchased it from the market, you will simply take the purchase price. If Blue has himself manufactured it, then you will see at what price would he have given the same thing to his customers. You will consider that as a value of the benefit. If the value of the benefit is more than 20,000, only then we will have TDS at the rate of 10%. It's an R hijack section, so you will bother about turnover and gross receipt if the deductor is individual or HUF. Then we learned extra points. GST you will not consider. Whether the benefit or perquisite is taxable for Green under section 28(4) or not, it is irrelevant. The benefit or perquisite can also be a capital asset, does not matter. Then we had learned over here, if a business loan is waived off by the bank, of course it is a benefit or perquisite and also taxable under 28 clause 4, but 194R will not apply. For social media influencers, if they get to keep the product, then it is a benefit for them. Then 194R will apply. But if they have to return the product, if they cannot keep the product, if they have to return the product, then 194R will not apply. Then we learned for bonus shares and rights shares also, 194R will not apply. And finally, we learned sales discount, cash discount, rebate, even here 194R will not apply. And then we learned if the same benefit this person starts using for his business or profession, he will ask depreciation. To claim depreciation, the asset has to enter the block. At this step, the asset enters the block. At what value will it enter the block? The same value which was taxed under 28 clause 4, at that same value only it will enter the block. This is it about section 194R. Now see, while we are done with the sections of TDS, there are some extra points with respect to TDS that I want to discuss with you. Alright, let's discuss some due dates first. See, the deductor has multiple responsibilities. First of all, he is supposed to deduct the tax. In some sections, we said he is supposed to deduct the tax at the time of payment. In some sections, we said he is supposed to deduct the tax at the time of payment or credit, whichever is earlier. Right. This is his first responsibility. He is supposed to deduct the tax. His second responsibility is that he has to remit the tax. Now, when is he going to remit the tax to the government? This I will discuss with you in 3 parts. See, we know very well under section 194IA, section 194IB and section 194M. It's a slightly different mechanism in these 3 sections. We are well aware of, guys. In these 3 sections, we say that from the end of the month of deduction, within how many days? Within 30 days, we are supposed to file the challan cum statement. So when we file the challan cum statement, we have remitted the tax also, right? Challan cum statement is a combination of 2 steps. Paying the tax, remitting the tax, step number 1, and step number 2, filing the TDS return. Challan, I'll repeat again, challan cum statement is a combination of 2 steps. It's a combination of remitting the tax and also filing the TDS return. So both are combined over here. So when the tax get remitted under these 3 sections, within 30 days from the end of the month of deduction, the tax was remitted to the government. Then listen, if the section happens to be section 192, TDS on salary, or had sections as in section 194H, section 194A, or section 194D. These are the had sections. So if any of these sections are applicable, section 192 salary section or had sections, here we will have to make the payment of TDS to the government quarterly. Like for example, the first quarter is going to be April to June. So April to June quarter, by 7th of July, we have to remit it to the government. Second quarter is going to be July to September. So by 7th of October, we'll have to remit the TDS to the government. The next quarter is going to be October to December. So again, by the 7th of January, we'll have to remit the tax to the government. And the last quarter is Jan to March. Jan to March, your answer will obviously be 7th of April. But for the last quarter, we will give extra time. We will give time till 30th of April. So for these four sections, the remittance of tax will be quarterly. Okay. For all the other sections, the remittance is going to be monthly. For all other sections, the remittance will be monthly. Like for example, for the month of April, by 7th of the next month, that is by 7th of May, we have to remit it. For the month of May, by 7th of June, we have to remit. So like this for each month, by 7th of the next month, we'll have to remit. But what about the month of March, the last month? For the month of March, we give extra time. We'll give you time till 30th of April. Okay, so the first responsibility of the deductor is that he has to deduct the tax. Second responsibility, he has to remit the tax. Now, when will he remit the tax? If I'm talking about 194IA, IB and 194M, 30 days from the end of the month of deduction, he will remit the tax. 192 and had sections, quarterly he will remit the tax by 7th of the next quarter. And all other sections, monthly he will remit the tax, that is by 7th of the next month. But keep in mind, for the last month and for the last quarter, you will get extra time. Then coming to the third responsibility of the deductor, he also has to file the TDS return, guys. The TDS return, which is also called as the TDS statement. He's supposed to file the TDS return, that is, he's supposed to file the TDS statement. Now, when is he supposed to file? See, if it is any of these three sections, you know very well, 194IA, 194IB and 194M, for these three sections, you know that the remittance of tax and TDS return both are combined into challan cum statement. So this challan cum statement has to be filed within 30 days from the end of the month of deduction. For all the other sections, how is it? For all the other sections, TDS return has to be filed quarterly. Like your first quarter is April to June. For April to June quarter, by 31st July, so next month, 31st July, we have to file the TDS return. Then the next quarter will be July to September. July to September, by 31st October, we'll have to file the TDS return. October to December, by 31st of January, we'll have to file the TDS return. And a last quarter, Jan to March, ideally it should be 30th April. But you know very well, for the last quarter, I give extra time. So instead of 30th April, you have time till 31st of May to file the TDS return. Okay, so TDS return, the TDS statement, when should it be filed? For these three sections, we file it within 30 days from the end of the month itself. For all other sections, it's going to be filed quarterly. Quarterly, next month it will be filed. Okay. Then coming to the last responsibility, the fourth responsibility of the deductor, he also has to give a TDS certificate to the deductee. Remember, I had told you all this in the first part of the first part of the last session. We had discussed about all this. So TDS certificate, when will the TDS certificate be given? See, if we talk about these three sections, 194IA, 194IB and 194M, in these three sections, from the end of the month of deduction, from this date, within 30 days, we do the challan cum statement, guys. From the expiry of this 30th day, within 15 days, the TDS certificate is given to the deductee. We are already aware of this. Then, if you remember, under section 192, TDS on salary, I had told you that TDS certificate under section 192 will be given annually. By 15th of June of the assessment year, this certificate will be given. Like for example, if we are talking about previous year 23-24, okay, for this year, the TDS certificate for section 192 will be given by 15th of June of 2024. So, under section 192, the TDS certificate will be given by 15th of June of the assessment year. What about all the other sections? For all the other sections, you will see what is the due date for filing the TDS return. whatever is a due date for filing the TDS return, from that day, within 15 days, the TDS certificate has to be given. Understanding? Whatever is a due date to file the TDS return, so these dates, from these dates, within 15 days, the TDS certificate has to be given. So these were 4 responsibilities that we discussed: deduction of tax, remittance of tax, filing the TDS return, and TDS certificates. Alright guys. Now coming to some punishments, the next discussion coming to some punishments, we'll discuss about section 234E fees first, and then we'll discuss about section 201(1)A interest. In a very brief manner, I'll give you the revision. Section 234E fees. What is this about? See, we're supposed to file the TDS return, right? We're supposed to file the TDS return. If the TDS return is not filed on time, the TDS return, also called as the TDS statement, if this is not filed within the respective due date, then 200 rupees per day, rupees 200 per day, we'll have to pay as 234E fees. So the deductor of tax does not file the TDS statement on time, then he'll have to pay 200 rupees per day of delay. He'll have to pay this as 234E fees. But however, keep in mind, this fees should not exceed the TDS amount. This fees should be within the TDS amount. It should not exceed the TDS amount. It should be within the TDS amount. So how much fees? 200 rupees per day. See, this is for both. This is for TDS statement also, for TCS statement also. If any of them are not filed on time, then 200 rupees per day of delay we'll have to pay as 234E fees. But this fees should not exceed the TDS or TCS amount, as the case may be. This is 234E fees. Then we have 201(1)A interest. Let me tell you about this now. See, we have two numbers over here. If the deductor that does not even deduct the tax, or let's say he deducts the tax late. So here we will see what was the due date by which he should have deducted the tax. What is the due date for deduction of tax, and when did he actually deduct the tax? So this is a period of delay, guys. When he should have deducted the tax and when did he actually deduct the tax? We will find what is this period of delay. 1% per month or part thereof is going to be 201(1)A interest. So 1% interest. Like for example, if this period of delay is 3 months and 6 days, even a part of the month we will count as full month. So 3 months, 6 days, we will count it as 4 months. So for this 4 months, 1% per month interest we'll have to pay. That is 201(1)A interest. So 201(1)A interest is going to be 1% per month or part thereof. But what if the deductor has deducted the tax, but he did not remit the tax on time? He deducted the tax, but he did not remit the tax on time. In that case, we will see what is the actual date when he deducted the tax. When did he deduct the tax? And then we will see when did he actually remit the tax. So what is the gap between when did he deduct the tax and when did he remit the tax? Whatever is this period, for that period, 1.5% per month or part thereof, this much 201(1)A interest has to be paid. So two things under 201(1)A. First of all, if the deductor does not deduct the tax on time, then we will ask him to pay 1% per month interest or part thereof. 1% per month or part thereof. Part thereof, you're understanding? Even a part of the month we will count as whole month. But if he deducts the tax but he does not remit the tax, then we will see when did he deduct the tax, when did he remit the tax, that time gap, 1.5% per month we will ask him to pay interest. So this was 234E fees and 201(1)A interest. Now listen, taking you to the next section, we have another section, section 206AB. A very interesting section, okay. 206AB, what does the section say? Let's say we have two people, we have the deductor and the deductee. Okay. Now the deductee happens to be a person wherein 2 years back as in, for us, our examination, May 2024 examination, November 2024 examination, our previous year is 23-24, right? So if you look at 2 years back means what? Preceding previous year 21-22. So 2 years back, that is 21-22, this deductee has not filed his ITR. He has not filed his ITR. And for this year, if you look at his TDS plus TCS credit, his TDS TCS credit is at least 50,000 rupees. So 206AB says that in such case, when the deductor is deducting tax, all right, against such a deductee, the TDS rate should change. The TDS rate should become higher. So 206AB puts extra responsibility on the deductor. The deductor, please check, has your deductee 2 years back, has he filed ITR? If he has not filed ITR, check in that year is TDS TCS credit at least 50,000. If yes, the TDS rate will change. The TDS rate will become 2 times of the applicable rate or 5%, whichever is higher. 2 times the applicable rate or 5%, whichever is higher. This is 206AB. So 206AB is saying that the TDS rate will change. When will the TDS rate change? If the deductee happens to be a person wherein 2 years back he has not filed the ITR and that year TDS TCS credit was at least 50,000. In such cases, the deductor will have to deduct the tax at a different rate, which is 2 times the applicable rate of 5%, whichever is higher. But please know that 206AB is not applicable to every section. 206AB is not applicable to multiple sections. It is not applicable to section 192 TDS on salary. It is not applicable to 192A TDS on RPF withdrawal. It is not applicable to 194B, your lottery winnings and all. Not applicable to 194BA, net winnings on online games. Not applicable to 194BB, horse race winnings. It is not applicable to section 194IA, purchase of immovable property. Not applicable to 194IB, rent which is not covered by 194I. It is also not applicable to 194M and 194N. To these sections, 206AB is not applicable. All other sections, 206AB is applicable. And exactly similar section we have even in TCS. Even in TCS, the seller will check whether the buyer 2 years back, has he filed ITR or not? If no, is the TDS TCS credit at least 50,000? Then same thing, the TCS rate will also change. So know that the same provision you have in TDS also, in TCS also. In TDS it is 206AB, in TCS it is 206 CCA. That's all. But the provision remains the same, even this remains the same. Now listen, let us complicate this a little bit. Let us say we're talking about section 194C. TDS on works contract. Let's say 1% is the TDS rate. Remember in 194C, TDS rate depends upon who is a deductee. If deductee is an individual or HF, TDS rate is 1%. So let us say 194C is applicable and also 206AA is applicable. 206AA, do you remember? 206AA, the section which says if the deductee is neither giving PAN nor giving Aadhaar, then the TDS rate will change. And let us say 206AB is also applicable, which means 2 years back the deductee did not file his ITR and that year his TDS TCS credit was at least 50,000. Let's say all these three sections are applicable. Then what will happen? In that case, see, we will apply 206AA also. We'll apply 206AB also. We'll see where is the highest TDS rate that will apply. See, I'll show you. First, I will apply 194C plus 206AA. What does 206AA say? 206AA says whatever is the applicable rate or 20%, whichever is higher, guys. So what is the applicable rate? Applicable rate in our example is 1% or 20%, whichever is higher. Which is higher here? 20%. Okay. Then if you apply 194C and 206AB. 206AB plus 194C, what does 206AB say? We'll take 2 times of the applicable rate or 5%, whichever is higher. So 2 times of 1% will be 2% or 5%, whichever is higher. So which is higher here? 5%. Now out of these two rates, you take whichever is the higher rate. So at the rate of 20%, tax is going to be deducted. Understanding, if 206AA and 206AB both are applicable, you apply both the sections and you pick the highest out of those two sections. Understanding, everybody? Yes, if both the sections are applicable, 206AA and 206AB, you apply both the sections and you pick the highest out of those two sections. Alright, now I'll take you to another extra point under TDS. One final point, guys. See, listen. Let us say Tata Motors goes to an ad agency and asks them to make one advertisement for them. So there's an advertisement contract. This is nothing but a works contract, guys. This will go to 194C. Remember 194C, A, B, C, C, and one important point, A for advertising. So if Tata Motors is going to ask an ad agency to make an advertisement for them, this will come under works contract, 194C will apply. Now listen, one more transaction is possible. Let's say we have a TV channel and we have an ad agency. This ad agency is procuring advertisements for this TV channel, or it is canvassing for advertisements for this TV channel. Basically, it is getting advertisements for the TV channel. Now, of course, TV channel is going to pay some commission to the ad agency. See, like for example, this ad agency made an advertisement for Tata Motors, and then it is bringing that advertisement to the TV channel. So TV channel will charge a bulky amount from Tata Motors. I am going to show your advertisement on my channel. You have to pay me money. So TV channel is going to get a huge sum of money from Tata Motors, and that income the TV channel is able to earn because the ad agency brought Tata Motors advertisement to TV channel. So to thank the ad agency, the TV channel is of course going to pay some commission to the ad agency. So when the TV channel pays commission to the ad agency for procuring advertisement like this commission will neither go to section 194H nor will it come to section 194C. TDS itself will not apply. It is commission. Generally, we are supposed to think about 194H, but 194H commission TDS will not apply. Even 194C will not apply. So this was one special point that yes, advertising comes to section 194C, but read the question carefully. If the question talks about commission for procuring advertisements, commission for canvassing advertisements, on that neither will 194H apply nor will 194C apply. Alright guys, so with this I think we've done our real best in revising this whole chapter of TDS. All the provisions with respect to TDS I've tried covering for you as much as possible. Now it's all yours. You go and kill it in the examination. Thank you guys. Bye-bye.